everyone who's here today, welcome. We're very excited to make sure that you are equipped for the Vancouver real estate market investor guide. And basically, if you are on this webinar and you own a property and you want to invest in a new one, there's going to be some pretty cool things we're going to talk about that give you the right tactics to do so. Now, you also might be someone who is renting and you want to find your next place and you want to be an investment property, you want to rent out part of it. You're either one of those two people. You're thinking like an investor and you want an investment property. Now, this could be your problem, is that you don't know where to start in terms of actual budgeting. I mean, think about all the different costs involved as you're actually buying a home, and think about the revenues and the costs. Like, how do we look at that financially? And then on the financing side, of course, you may not be sure, how do I produce enough down payment to be able to invest in the property that I want? Or maybe you went to the bank and they just didn't give you the mortgage size that you're hoping for. And I know for a fact some people that I've talked to recently and perhaps on the call have gone through this. So we want to get through that. And it's all about being creative. So with that, we're going to go through a bit of the agenda. Number one, of course, quick introduction so you understand a bit of where our expertise lies. It's a very exciting time now. Specifically, the current market climate really gives us a good indicator on why it's good to get in. We're going to talk about the different investment property types, whether it's resale or pre-sale, the pros and cons there. If you own a home, it's how do you actually use home equity for your down payment on your new place without having to actually take cash out of your bank. And how do you buy if you can't get enough mortgage? We'll be talking about alternative lenders from that standpoint. And just really quickly, with when you're looking at resale versus pre-sale, number one, if you're looking at resale, usually it's you're buying now. Okay, you need 20% down. You have the down payment ready. You have the mortgage affordability ready, whether it's with a bank or with an alternative lender, and off you go. You can start making money right away, especially rental income. Now, if you're from the side that you don't have your 20% down payment yet, and or you're getting a raise in the next little while, or you're paying off debt, so your mortgage affordability isn't quite where you want it, pre-sales are amazing because usually you start with 10% and you have time to actually save for your down payment and to qualify for the right mortgage over a duration of anywhere from 1 to 5 years, right? So the main thing is you don't want to sit on the sidelines as the market gets away from you. Let's talk about exactly how we can avoid that and be thinking like an investor. So very quickly with introductions, for those, of course, who don't know me, I founded Level Up Mortgages really on the premise that I really love working with people who have an investor mindset. And usually these people are self-employed, but not limited to. And what really kills me is when I see people that make pure emotional decisions. I understand this whole process. It's very emotional. When you think like an investor and you're not just putting blind faith in the bank and you want to just explore other options like any good person does in their due diligence, I think that's really important. And that's what I thrive off the most. Now, I'm a serial entrepreneur, worked a lot in tech and marketing. And generally speaking, I work a lot on getting people money, whether it's getting my clients capital or getting myself capital. It's all about how do you sell a story to an investor or an institution by using numbers and a little bit about the actual practical side. And maybe you pull a bit on the heartstring. Those are all parts of sales that are very important. And it really is something that, it's amazing to see people's life level up after you do that. And, lastly, as far as my reach and, kind of why I do these presentations, I mean, I've gone anywhere from smaller presentations to pitching at tech companies like Amazon. Everyone actually has very similar questions. And I think it's crazy how much of a lack of knowledge we got in school, right? Or how much of a lack of knowledge you get from just one local bank branch. So our whole thing is giving you the straight facts so you can make your own decision, but it's making decisions from a position of power. And of course, I operate in mainly in BC, but also Ontario and beyond. And we've got many lenders, which some of them are banks, by the way, TD and Scotia primarily. But there's other mortgage lenders that no one knows about, and they actually offer some really great stuff. And lastly, I graduated from UBC and I speak Spanish. I'm from Mexico City. And yeah, I always love connecting with interesting people. So with that, that's a bit about me. And now we're going to hand off to Amir now for his introduction. And he's going to get right into the market update as well for people that are looking at where that's all going. Amir, take it away.
Hello.
Yep, we're good.
Okay, awesome. Okay, all right. Thank you so much, Paul. So my name is Amir Shojaee. I'm a full-time realtor here in Vancouver, licensed with Stonehaus Realty, and I myself, I've been a lifelong resident of Vancouver. I went to UBC here and graduated with a bachelor in civil engineering and a master's in construction management, but been shifted to real estate and been doing this full time now. And my aim for all my clients is to ultimately educate and guide them through the entire real estate process from beginning to end so they can make an educated decision. And I'm with them throughout the whole process to answer any questions they have. So uh, just move on to the next slide, please. So the main question a lot of people ask me, especially my investors, is that, should we buy an investment property? Is real estate a good investment here? So there is a couple things where it comes to real estate investment. It's really important to know. Essentially, for investment, you have two investment options. The first one is an option to buy a pre-sale project, which is basically you're buying a property that's not yet constructed. You're buying it in the pre-construction phase, and usually with pre-sales, you don't need a mortgage right now. And what you do is you just put a deposit which is anywhere from 10% to 20% depending on the project, and a lot of times we can negotiate and stagger out the deposit so you don't have to pay it all up front. We can do it where you pay the 10% in a course of 6 months, 3 months, or we can negotiate that with the developers. And then what happens is you have no other payments, no mortgage, nothing needed for the next 2, 3, 5 years until the project completes. And ultimately, once the project completes, that's when you would need to get a mortgage, and you'll get you'll get your property. So the main benefit of a pre-sale is for people who can't qualify for a mortgage right now, and while they want to get into the real estate market, pre-sale is a very solid option. And another option for my investors is resale properties, where you buy a property that's already built, and you buy it from another owner, and you can put a tenant in there, or you can potentially move yourself into it if you're currently renting. But if it's the case you're going that resale route, you would need to be able to qualify for a mortgage right now. If it's an investment property, for you to qualify for a mortgage, you would need 20% down payment at least if it's an investment property. And yeah, and a lot of times, with the current Vancouver market, prices usually go up 3 to 5% every year. So, I'll show you guys some potentials, and what are the potential return on investments for both pre-sale and resale. The main thing with real estate is you do get high leverage with real estate. So a lot of times, because you're putting 20% down payment, the other 80% is mortgage, and you do get quite a bit of leverage there, which is amazing with real estate. And then obviously now, there is going to be, my prediction is that there is going to be increased demand for condos as new immigrants arrive within the next 3 to 4 years, because a lot of people have been waiting for COVID to slow down. So a lot of new immigrants coming, and all these people would need a place. So my personal opinion is, as COVID slowing down, the demand for condos is going to increase quite a bit, whether it's the rental market or even the property. And another benefit of getting in an investment property now, especially a resale one, is that the interest rates are pretty much low right now. It is expected that they will increase within the next, 3 to 5 years. So if you buy an property now, you can kind of fix your low interest rate for at least the next 5 years, which is good. And obviously, if you a lot of people who currently own a home but don't have enough cash to buy a second property, Paul will cover different options where they could use essentially their home equity line of credit, which we call it HELOC, to pull out some cash to buy a second property. So the next thing I want to kind of cover is some potential on an investment property and what type of returns you should be expecting. So just to give you guys an example here, let's assume you buy a resale property, meaning a property that's already built, and let's say you buy it in a area which is very up and coming, like Langley with the future SkyTrain going there. That's just one example. Let's say you buy a one bedroom for $400,000, and then let's say you secure a mortgage for 1.59, 3-year fixed. Let's say assume you put a 20% down payment, 25 years mortgage length, unit size 500 square feet, and let's assume you put a tenant in there, and the tenant pays you 1550 every month, and then we're assuming a 3% rent increase, and we're also assuming annual price appreciation of 5%, which is on the conservative side. I have all the stats details for every neighborhood, but 5% is usually a conservative estimate in terms of price appreciation in the Vancouver real estate market. And then we're also calculating in our calculations all the expenses you have when you buy a home, including property tax, strata fee, insurance, and all those stuff. So just to give you guys what are the potential returns on investment, and what what numbers and returns you could be expecting in the next 5 years, 10 years. Just go on the next slide, please. You can see, this is kind of, if you look at 2021, so this is year one, which is now you're buying a property for $400,000. You're gonna put a tenant in there, which is gonna pay you 1550 every month. So the rent you're collecting every year is gonna be 18,600. And then you have your strata fees, your mortgage payments, you have your property taxes. So your net cash flow at the end of year one is going to be 1300. So that's how much you would have to put from your pocket every year, which is a very small amount. It's going to be like 100-ish bucks a month, which you have to put from your pocket to cover all the expenses. And then with real estate, as you might know, it's always a long-term investment, right? So let's assume you keep it for 5 years, and in 2026, the property is roughly going to be worth 486, and as the rent value increases, um, the property, you're going to start seeing some positive cash flow. So it's going to start, paying for itself. You can see the cash flow starts to get positive. So that's how much positive cash flow you're going to get every year. And, let's assume you keep it for 5 years. At the end of year five, once you sell it, there's a potential that you'll keep $83,000 worth of profit, which is 100% return on your investment capital, because essentially at first to start, you only put 20%, and you're getting $83,000 after 5 years. So that brings it down to 104% return on investment, which is fairly decent for real estate investment. And it's the main reason for this is because of the high leverage you get with real estate, right? Okay, and then the next one I wanted to cover is pre-sale property. So this is the example where we said, if somebody, doesn't want to get a mortgage right now, or, foresees themselves being able to qualify for, a mortgage in the next 3 to 5 years, or they see themselves, paying off a debt, or having an increased salary, or saving up a little bit more for down payment. Pre-sale is an amazing opportunity because it allows you to get into the market, secure a property at today's price, and not having to pay any mortgage or get a mortgage, strata fee, anything for the next 1 to 5 years, depending on when the project completion is. So for an example, we're gonna use a property which is a pre-sale property. Can you go back, please? So we're going to use a property which is completing in 3 years. So you put your deposit now, and then the project completes in 3 years. So you don't need a mortgage for the next 3 years. And we're going to keep all the numbers the same. So $400,000 purchase price, mortgage rate 1.59, down payment 20%, annual price appreciation of 5%. And then, all the costs pretty much the same as previous. The only difference is this one where it's a pre-sale, so it's going to complete in 3 years. So now if you go to the next slide, you can see that, in year one, which is going to be 2024, basically 3 years from now, that's when the project would be completed. So your property is going to be worth 463 roughly, right? But you purchased it and secured it for $400,000. So right off the bat, if you were to just sell it at that time, you would still make some good money. But again, with real estate is always a long-term investment. So I always tell my clients, best to buy a pre-sale, keep it for another 3 to 5 years from the time the project completes, and that's when you're going to see a really good return on your investment. So you can see here that in 2029, which is essentially 8 years from now, so 3 years till the project completes, and then let's assume once the project completes, you put a tenant in there for 5 years. At the end of year five, if you sell it, which is going to be in 2029, your purchase price is going to be around 562. If you were to sell it at that time, that's the rough estimate of how much you can sell it for. And then, as you can see, your rent is going to be 1900 roughly, because we assume the 3% rent increase, and then you have all your expenses. So your property is going to be actually positive cash flow by 2000 every year. So it's going to be pretty much not only paying for itself, but it's going to leave you with some extra cash every month. And then, let's say you sell it in 2029, you're looking at a profit of $168,000, and that's a 210% return on your investment. Okay. So just to give you some perspective, this with real estate, because you have high leverage, it's always a solid investment, but it's a long-term investment, right? So you got to give it at least 5 to 7 years. With pre-sales, it basically buys you a little bit more time as well. So we have a question here which says, aren't the pre-sale prices already taking that future increase in value into account? From the prices I see, I feel they take an aggressive increase rate when pricing the units. Yes and no. So generally, new construction is always a little bit more expensive, right? So even when it comes to pricing a property down the road, you can't really compare a price of a 10-year-old building with a building that's newly built, right? So that's the thing. So, generally speaking, pre-sales are a little bit more expensive, but the main reason for that is because they're new homes, and generally newer buildings are a little bit more expensive in terms of price per square foot compared to older buildings, right? So, essentially, the price you buy it, if you still assume a 5% price increase, you're still gonna get a good solid return. So yeah, that's. I hope that answered your question. If that didn't, at the end we'll have a Q&A and we can kind of talk about this more in detail.
Great
Um,
question.
yeah, but really great question. So then next slide, please. So now I'm just gonna pass it off to Paul, where he's gonna talk about refinancing your home with a HELOC for down payment. So this is more tailored towards people who currently have a home and they want to use the equity they've built to buy an investment property. And then also he's gonna talk about alternative lenders. So for people who also can't get enough mortgage right now, he has some really great solutions where he can assist you to qualify for a little bit more mortgage by using an alternative lender. So I'm just gonna pass it down to Paul and let him to take it on from here.
Awesome. Thanks so much, Amir. That was incredibly insightful and so much in so little time. So that's awesome. So remember our scenario, everyone. We have the scenario of like you have a place, you have a bunch of equity, and can you use that for down payment and maybe even get a cheaper rate while you're at it? Now, a lot of people will say, I'm renting, I want to get a place. What do I need to get sort of lined up? Well, number one, as Amir said, 20% is your magic number. Not only does that help you avoid mortgage default insurance, you can afford a lot more. And it actually is required by law. If you have an investment property, lenders want to see 20%. Any alternative lender also wants to see 20%. So that's something you got to work towards. There are programs that let you actually borrow for down payment. You can get down payment gifted from someone. There's certain rules around that. So if you don't have a property to tap into for equity, we can, of course, talk offline. Now, in this situation, if you do have a property that you can take out equity, well, how much equity and what's the cost of that? Because there could be penalties. So we'll get into that for this section. Really quickly, as a bit of a refresher, as Amir said, fixed rates are rising, right? So now is a very unique opportunity for you to take advantage of a low rate. The stress test happened fairly recently. So that's one thing that has actually lost you 5% of affordability. So if you got pre-approved for a mortgage of $500,000 in May, now it's $475,000. Hopefully that cools off the market. We'll see. And lastly, affordability is going down, not just because of the stress test, but also because of the strata insurance crisis. What that means is that essentially your strata fees are now more because of the insurance crisis. And of course, the buildings have to pass on the premium to, well, you. And with a mortgage, the more debts you have, whether they're current debts or what will be future debts with your mortgage, with your strata fees, that kind of hurts. So it's this window that's closing, and it can be the right one to act on, assuming that everything starts to line up. A bit of a story. Everyone likes stories. So here is a lady called Lisa, lovely lady. She said, Paul, I called my bank, and if I break the mortgage, there's a penalty of $27,601. So, is it worth me breaking my mortgage so I can consolidate debts? And she was also thinking of an investment property as well. So, she needed liquidity. So, but there's penalties in the way. And you might find that if you are on the call and you have a fixed rate and it's at like 3 point something, you're like, wow, rates are so much lower now, and I want to take out equity, but there's a penalty in my way. Is it worth it? Well, guess what? Run the numbers. And actually, once I ran the numbers with her, what was kind of interesting is that she was net $45,000 better off in 5 years based off of her rate going down to 1.5% from 3.5. She paid off debt, so there's no interest charges. And she got to kind of increase the value of her property through a renovation. So I always say look at opportunity costs. Do not let your bank spook you with a big breakage penalty. It does kind of suck if you have to use it. You have to pay it, of course, but it might still be worth it. So face the numbers. Remember, we want to go from emotional decision-making to actually being as financial as possible. That's why everyone on the call and the webinar today has an investor mindset. Now, why refinance now, though? I talked about, well, number one, if because of the recent appreciation of properties, there's more equity to play with to put to work. Secondly, as we said, rates are low. And with Lisa, she went from a 3.5 to a 1.5, and she took out money. So remember, when you refinance, you can actually take out home equity and change your mortgage rate and structure, which can work very well. So quickly, how does it work? So number one is you always have to own at least 20% of your home. Right? So let's say if Lisa, her house is worth $1 million and she had a $500,000 mortgage and she owned $500,000 of the home. How much can she take out if she, no matter what, must always maintain ownership of 20% of the property? Bit of a trivia question. Feel free to answer if you like, if you've got a quick answer there. Let's see if there's any answers. People are still thinking about it. Is it a trick question? Okay, nice. So 300,000. So why is that? Good job, Satish, right? So if she takes out 300,000, guess what? Her equity goes down from 500,000 to 200,000, and 200,000 is 20% of the million. So that is her floor. So correct. 300,000 is her max. So always work backwards when you're doing that kind of math. And also keep in mind, there are extra fees. They're not major, but there's some fees, and it might not happen right away, right? Now, remember, too, you have to actually get requalified. So if you suddenly got your house before you made income or there wasn't a stress test and now there is, it might come back to haunt you, or you might have to look at other alternatives. And before we talk about that, I touched briefly on breakage penalties. And that's why I tell a lot of people today, consider doing a variable, because if you do a fixed rate with a bank, which of course they love selling people, it's roughly a 4%. 4% of your mortgage is the penalty. So with Lisa, if you've worked backwards from the math, like she was, again, almost $30,000. If you really want to do a fix and maintain what are some record low rates today, then I usually recommend a mortgage lender that is not a bank. They're a bit more generous with penalties. And if you do love going with the bank, but you don't want a big breakage penalty, variable rate mortgages with banks or non-banks, it's only 3 months worth of interest. So on a $500,000 mortgage, here's some numbers. If you had a fixed rate, if you did a variable, whether it's with a bank or a mortgage lender, $2,800, which is a little bit less than the other ones. So all pros and cons, things to think about as you take out your crystal ball. Now, okay, let's say you have the down payment taken out from home equity, or it gets it to you. A lot of people do struggle in actually stretching your budget of how much lenders are going to lend you. And again, banks are mandated to stress test you. So it's not usually what you expected. So that's why alternative lenders are more important than ever. And we'll talk about an example alternative lender in a subsequent slide. But the key factors, again, the stress test. Because of the stress test and the stress test being even more strict, we need more options. Secondly, because of self-employed surge with COVID and just the way the world's going, there's more alternative lenders that are offering better solutions, and they're more generous with how they count your income, which is generally the tricky part with banks. It's not just the stress test, it's them not counting all of your income because it's variable, right? And as I said before, surging home prices equals more equity to take out. Here's a cool example. There's actually an alternative lender, also known as a B lender, who has no stress tests, and you can extend your amortization or your mortgage lifespan from 25 to 40 years. Basically, what does that do? That means you can still hold on to more debt. You don't have to pay off all your debts, which I know can be difficult. Also, you can have a little bit less income, but afford more. So let's have an example. So actually, in this example, you're going to afford $400,000 more with an alternative lender. It's going to cost more, but this is when your investor mindset's going to kick in. You're going to be like, does paying more mean I have a higher upside financially in the future? So, example, a prime lender or an A lender, as we call it, you can afford $640 as maximum mortgage. That's the rate. That's the monthly payment, and it's a standard 25-year amortization. Okay. Now, the place you want is going to need a much bigger mortgage. So, with a B lender, or in this case, this company called NPX, they can, with the exact same income and debt that you have right now, they can qualify you up to $1,040,000. $400,000 difference. Think about that. That's over 66%, right? Of what the A lender could do. Now, of course, since you have a much bigger mortgage and it's a higher rate, you've got a higher monthly payment, right? So you take the difference of $2,800 and $4,200 here, and I mean, is it worth it? Well, this is a thing that Amir was talking about. It's like, well, what's your rental cash flow and how much is it going to appreciate by? And you might see that, with the 640, you can only afford a condo and the rent's going to be, I don't know, 1,800. But with this guy here, and this is just the mortgage, right? Plus your down payment, like maybe it's, $1.3 million. Well, that might have, the ability to rent out the basement, the whole upstairs of the house. And maybe if your rental income per month is marginally more than the difference of these two, right? Let's say it's more than $1,400 a month because you have a whole other area to lend, or to rather to use. It might be worth it to pay a little bit more because there's more rental income. And then again, in the next 5, 10 years, 15 years, whenever you might sell, talk to your realtor. Well, what's the appreciation projected to be in this specific area? If I look at like a townhouse or a detached versus a condo. If you do run the same numbers Amir walked you through, it might make sense to afford more and pay more per month. So that's where, as an investor, there's no right or wrong answer. This is something for you to figure out, but you got to know what questions to ask yourself and what questions to ask your lender and your realtor and your whole team. So this is something that I always love to just walk you through the numbers, let you make the right decision. And with that, look, we're recapping already. So we talked briefly about home equity, right? And how to potentially use it without having to use your own savings for a new place. We talked about how to buy if you can't get enough mortgage. That's literally what we just talked about on the alternative side. And then, of course, Amir talked a lot about pre-sales versus resales and exactly what you need to know from both of those, right? And whether you have the down payment now and you have the mortgage eligibility today, or you have to wait and you got to buy some time. Does buying time make sense for your investment and your home purchase? And with that, what do you do next? Well, of course, we're quite available to actually run the numbers with you. And that's the most important part. It's running numbers, running spreadsheets, having a plan B, and being able to pivot that plan along the way. And you know how to reach us. Here is all our information. With that, we're very grateful for the questions we've had today. Love the attendance and happy to answer some questions now before we say goodnight. So with that, are there any questions that we've sparked for the fellow investors in the room around pre-sale versus resale, or anything around the financing side? We'll open it up right now. Thanks again.